Okay, thank you everybody for being here. I'd like to call the meeting of the Council to order. Let me first note that my colleague, Controller Otting, I believe has joined us by telephone. He couldn't be here in person. We have two agenda items today. First, we'll hear a presentation and vote on the Council's 2018 annual report, and then we'll vote on the minutes of the Council's previous meeting. So with that, let's turn to our first agenda item. FSOC's annual report is the product of extensive analysis and a collaboration across all the Council's member agencies. It explains the Council's views of potential risks across the financial system for Congress and the public. It also includes recommendations for specific actions to mitigate those risks where necessary. This report highlights recent accomplishments and also areas where further work is needed. I'd like to thank the members of the Council and their staff, especially their staff, for working so hard to prepare this year's report and for their ongoing efforts to make the financial system stronger. Let me turn to Bimal Patel and Stephen Ledbetter, who will provide an overview of the report's findings and recommendations.
Thank you, Mr. Secretary. I'll read a short prepared statement. I'd like to begin by reiterating the Secretary's thanks for the staff from around the Council member agencies, and in particular my team for its diligent efforts in developing this year's annual report. As you know, the Council is required by statute to report annually to the Congress on the activities of the Council, significant financial market and regulatory developments, and potential emerging threats to U.S. financial stability. The statute also requires the annual report to include Council recommendations to enhance the integrity, efficiency, competitiveness, and stability of U.S. financial markets, to promote market discipline, and to maintain investor confidence. The report is a collaborative document that reflects the collective judgment of the Council. The Council continues to serve as a forum to facilitate coordination among financial regulatory agencies to monitor market developments and identify potential threats to financial stability. The report notes the strong economic growth of the last 2 years, while emphasizing the importance of remaining vigilant regarding potential emerging threats to financial stability. The report states that overall risks to U.S. financial stability remain moderate, though they have evolved in the last year as the report details and as I will summarize in a moment. The report also states that financial stability risks outside the U.S. appear to have increased, most notably the potential for a disorderly United Kingdom exit from the European Union in March of 2019 could have serious implications for some global financial markets and firms. The report describes actions by financial regulatory agencies since the last report, including steps designed to make financial services regulations more efficient and effective. These include proposed changes to modify requirements under the Volcker Rule, Federal Reserve tailoring of enhanced prudential standards for bank holding companies, and agency-proposed rules to create a more efficient regulatory framework for exchange-traded funds. The report recommends that Council member agencies continue to address regulatory overlap and duplication, modernize outdated regulations, and, where authority exists, tailor regulations based on the size and complexity of financial institutions. The Economic Growth, Regulatory Relief, and Consumer Protection Act, signed into law in May of 2018, should provide more tools for Council member agencies to achieve these objectives. The report also notes the Council's continued focus on promoting market discipline to reduce the risk of future financial crises. The Council will work with regulators to analyze ways to promote market discipline and to reduce any lingering perceptions that some institutions are too big to fail. This year's report emphasizes 11 key areas of potential risk, which I will briefly highlight, along with corresponding recommendations included in the report. The first of these areas is cybersecurity. The report notes that as the financial system increases its reliance on information technology, the risk increases that a cybersecurity event in the industry will have severe negative consequences. The report describes the channels through which a cybersecurity event could threaten the stability of the broader financial system, and it makes a number of recommendations to address this potential threat. The report recommends that member agencies ensure a robust and consistent standard of cybersecurity monitoring and examinations of financial markets, institutions, and infrastructure. At the same time, the unique and complex threats posed by cyber risks require the public and private sectors to cooperate to identify, understand, and protect against these risks. The report encourages the use and development of these partnerships, including efforts to increase the harmonization of cybersecurity examinations across regulatory authorities. The second theme is central counterparties, or CCPs. The report states that due to the critical role CCPs play in financial markets, effective regulation and risk management of CCPs is essential to financial stability. The report notes that CCPs have taken steps aimed at improving risk management practices and providing greater transparency, consistent with the requirements adopted by their regulators. The report recommends that member agencies continue to evaluate whether existing rules and standards for CCPs and their clearing members are sufficiently robust to mitigate potential threats to financial stability, and that supervisory agencies continue to conduct evaluations of the performance of CCPs under stress scenarios. Additionally, the report recommends that agencies continue to monitor and assess interconnections among CCPs, their clearing members, and other financial institutions, assess appropriate quantitative data and disclosure standards, and promote further recovery planning and development of resolution plans for systemically important CCPs. The third area is reference rates. With respect to reference rates, the report notes that reliance on LIBOR remains high, and the weaknesses of that benchmark may undermine market integrity and financial stability. The report commends the significant progress of the Alternative Reference Rates Committee, or ARC, during the last year to establish the Secured Overnight Funding Rate, or SOFR, as a viable alternative to LIBOR. More work is necessary to complete the transition away from LIBOR. The report thus encourages market participants to consider potential uses of SOFR in new transactions. Where participants continue to choose to reference LIBOR, the report encourages them to make the LIBOR-linked contracts more robust in accordance with guidance provided by the ARC. The report recommends that member agencies work with market participants to identify and mitigate risks from potential dislocations during the transition process. The fourth area is capital, liquidity, and resolution. The report describes the improved resiliency of many financial institutions in the years since the financial crisis, particularly through strengthened capital positions and improvements in their ability to respond to draws on liquidity. The report recommends that agencies continue to ensure that the largest financial institutions have sufficient capital and liquidity to reduce their vulnerability to economic and financial shocks. It also recommends that regulators monitor and assess the impact of rules on financial institutions and markets, including on market liquidity and incentives to centrally clear derivatives. The fifth area is wholesale funding markets. The report also highlights risks related to short-term wholesale funding markets. The report cites the progress made in recent years to reduce risk in these markets, particularly the reduction of counterparty risk exposures in repo markets and the 2016 reforms of money market mutual funds. Given the continued importance of these markets in the U.S. financial system, the report recommends continued monitoring by relevant regulators. Specifically, the report recommends an assessment of the increased concentration risk in the tri-party repo market. Greater understanding of the repo market should be aided by a new proposed OFR data collection on centrally cleared repo, continued monitoring of the 2016 reforms of money market mutual funds, and an assessment of the potential risks posed by other types of cash management vehicles. The sixth area is financial innovation. The report discusses potential implications of financial innovation for financial stability. It highlights that new financial products and practices can offer substantial benefits, but they may also create new risks and vulnerabilities. The report discusses technology-enabled financial products such as digital assets and notes the ongoing work of the FSOC Digital Asset and Distributed Ledger Technology Working Group. The report recommends that financial regulators monitor and analyze the effects of new financial products and services on consumers, regulated entities, and financial markets, and evaluate their potential effects on financial stability. The seventh area is data quality, collection, and sharing. With respect to data quality collection and sharing, the report notes the important steps taken to address data gaps exposed by the financial crisis. The report also discusses the continued reliance by market participants on data that are not aligned to standard definitions and that inhibit data sharing. The report makes a number of recommendations that regulators and market participants further improve the coverage, quality, and accessibility of financial data, including through use of the legal entity identifier in regulatory reporting and other agency data collections where appropriate. The next area is managing vulnerabilities among prolonged credit expansion. The report discusses these vulnerabilities associated with the long credit expansion in the U.S. The report discusses a number of metrics that indicate that non-financial corporate debt and leverage are elevated. It also discusses indication that valuations may be elevated in key U.S. financial markets, including equities, corporate debt, and some commercial and residential real estate. The report notes that these elevated leverage and asset valuations can make downturns in these markets more severe. The report also notes that strong interest coverage and liquidity positions have allowed businesses to service their debt with low delinquency rates, but these factors may not prevent increased defaults if business earnings were affected by a recession or other financial shock. The report points out that any potential impact on financial stability would depend on the extent and severity of defaults, whether there are spillovers to other markets, and the ability of investors and intermediaries to manage the fallout. The report recommends that agencies continue to monitor levels of non-financial business leverage, trends in asset valuations, and potential implications for the entities they regulate in order to assess and reinforce their ability to manage severe simultaneous losses in those markets. The report states that assuring that relevant investors and intermediaries can manage such losses rather than amplify or transmit them will reduce the risk to financial stability such a scenario could pose. The ninth area is housing finance reform. The report includes a discussion of housing finance reform and notes that Fannie Mae and Freddie Mac are now in their 11th year of conservatorship. The report further reaffirms the need for housing finance reform to create a more durable and vibrant housing finance system that enhances financial stability. The 10th area is changes in financial market structure. The report also includes a discussion of changes in financial market structure, such as increased use of automated trading systems, the higher speed of transaction quoting and execution, increased diversity of liquidity providers, and the expansion in trading venues. The report explains that such changes and complexities may create unanticipated risks that can interrupt normal financial market functioning or, in a severe case, amplify threats to financial stability. The report recommends that market participants and regulators continue to evaluate changes that may have adverse effects, assess the factors that could cause stress to propagate across markets, and consider potential ways to mitigate those risks. The next area is asset management products and activities. With respect to asset management, the report reaffirms the Council's focus on ensuring adequate information to evaluate risks in the asset management industry. The report notes rules issued or amended by the SEC to promote liquidity risk management and enhance data reporting by registered investment companies. The report recommends that the SEC evaluate the extent to which those rules address potential risks in the asset management industry. Regarding private funds, the report recommends that relevant regulators review their data collections and assess whether they are sufficient for the Council to monitor whether and how private funds may pose risks to financial stability. Thank you again, and I'd be happy to address any questions that you might have.
Bimmel, thank you very much. Terrific. Great. Thank you very much. The resolution is approved. Okay, for our next order of business, has everybody had an opportunity to review the minutes? Okay, do we have any comments on the minutes? If not, is there a motion to approve the resolution approving the minutes of October 16th of the council meeting?
So moved.
Do we have a second?
Second.
All in favor?
Aye.
Any opposed? Thank you very much. The resolution is approved. Okay, do we have any other issues for the committee? If not, do we have a motion for adjournment?
So moved.
Do we have a second?
Second. Second.
All in favor?
Aye.
The meeting is adjourned. Thank you very much, and wishing everybody a happy and healthy new year.